No matter how you look at it, we're paying far higher gas prices today than we did a year ago. More for groceries, more for goods and services. So when is this inflation balloon going to finally pop? Well, let's welcome back David Monckton, financial advisor for Carolina's Wealth Management. I will pose that question to you. When is it going to stop?
Thank you for the easy question. As we know, we had a big announcement last week from the Fed. We also had it followed up by a jobs number on Friday. Those numbers are super important. No one knows the answer to the question. What we're dealing with now is, if you probably don't remember, Layla, back in the 70s, we had a 10-year trend of inflation. And the issue we had there is we didn't fight it quickly enough, and then we ended up jacking rates up double to bring it down. Took us through 2 tough recessions. With the Fed's walking a tightrope now, they're raising rates, trying to slow down that demand without taking us into recession. Now the latest metrics show that some of the leading indicators for inflation are starting to cool down. Rents have started to come down. We've seen housing prices, more so around the nation, the hotter areas come down. In our area, housing prices have been a little bit more steady. And that's supply demand driven as well. You know, we're still, even though prices have gone up a lot the last 10 years, the September number was in South Carolina, house prices were up 16% year over year. But we're still cheaper.
Crazy.
It's good for all of us,
Yeah.
homeowners, but it's still cheaper to move here, and people are continuing to do so. So our lack of supply, given the demand we should see, may help our housing market. But globally, over the country, we're seeing housing prices come down, which should help the Fed hopefully get to a point where they're not going to be as aggressive raising rates.
How long do you think this is going to take? Because also, let me ask you this. You know, you were saying, you know, if we do fall into a recession.
Right.
So in your opinion, and depends on who you ask, either we are in a recession or we're looking to possibly enter into one. What do you think?
It feels like we are. The definition was 2 consecutive quarters of negative growth. We had that earlier this year. The third quarter, we had positive growth. The oddity we're dealing with now is the labor market has been so strong. We've got low inflation numbers. The jobs numbers continue to be positive. And the thing the Fed, I think, is really concerned about is more of a wage price spiral, whereas people continue, there's demand for labor, so we got to pay people more money. They've got more money to spend on a finite number of goods and services, the prices go up.
Right.
Companies have been coming out with third quarter earnings. October was a pretty good month for the market because of that. Yeah. McDonald's says they expect prices to go up 10% next year. MasterCard.
A dollar menu, say goodbye.
Well, you know, that's really going to impact me at McDonald's. But the big thing is, you know, MasterCard, American Express, who kind of know what we spend money on, consumer hasn't slowed down. They expect it to continue to go next year.
Well, when you talk about the credit cards, a lot of people are putting things on their credit cards that they normally would have the cash to pay for it. And when we're talking about jobs, because I just want to let everyone know, you know, a recession by definition means unemployment rises, total employment falls, the GDP growth shrinks, and lower production of goods and services. So you have to have kind of that perfect storm for it to be called a recession. But when you're talking about, well, the employment numbers are good, well, what kind of employment are we talking about? Because are these just little part-time jobs that are paying just not enough? And
I think a lot of the strength we've seen in the employment numbers are the lower end of the job scale. Maybe it's people having multiple jobs to make ends meet. You know, if you go to the grocery store and you go fill up your car, there's just less money to go around. I don't care where you are on the economic scale, there's less money. And if there's less money, then there's less to go chase these other goods and services. Now, at the same time, companies are coming out and saying that because the job market has been relatively strong, or people have money in their pocket, they're able to pass that along. And until they're not able to do so, we're probably going to see inflation be kind of sticky. You know, the Fed had wanted to get back to an inflation rate of 2 to 3% at the end of next year. I don't think that's likely without a big economic shock, a recession, a relatively deep one.
You know, the Great Recession, 2008.
Right.
Horrible time. took a really long time to recover. What are we looking at in terms of recovery time for us
I
here?
don't think we're looking at that. There was a lot of wealth destruction then. You know, we had people buying homes, you know, beyond their means, and then they went down in value and people were walking away from
It was a
them.
mess.
We're going to see real estate prices come down nationally, but people still will likely have equity in those homes.
Okay.
We've got people that have, most of the rates are locked in below 3%. You know, they're not going anywhere. They've got some equity. We're going to go through a difficult economic transition, but what the Fed's trying to do is not have a decade of inflation like the 70s. They want to have a couple years of it.
I want to thank you so much for your time.
My pleasure.
We're back after this.